It's been a long time. Ultimate Traders and Reddit. Here I am, March 3rd, 2024. It's probably been like at least 4 or 5 months. So I've been wanting to do a couple of videos, but not a lot of videos because I haven't actually been trading too much. I've been trading more this year, 2024. 2023, I was on the sidelines, and you know what? I didn't mind. I'm gonna do 3 videos. This first video, I was mentioning a whole bunch for many months, raising shareholder value. So too many people think that the stock market is some mysterious thing that they're willing to just pay up for anything. When you do this a very long time, or you're like Warren Buffett, or you're like me, or you're like someone else, I guess you can call us value investors, but we're like entrepreneurs. We're people that want to invest like ownership of companies. Like if you yourself weren't in the stock market, right? You weren't in the stock market yourself. So the way that so in the 90s when I started trading, I was also a momentum trader, like a day trader. Once I started doing this for a long period of time, I realized that I'm actually buying into a company. I'm owning a company that's going to, in return, give me some money or give me a reason to buy, to go long. Warren Buffett believes, as long as you buy a company and the leadership is great, that you could own it forever. Because whenever there's something that happens in the business, they will adapt. There's not too many companies like that. But anyway, this video is about raising shareholder value. So the stock market is an easy way to get investment into a business or company without having to start an LLC or start a corporation. So the stock market is a very simple way. Before the stock market, how could you have a business? And if you yourself were going to invest in business, let's say you were going to invest $10,000 into the business, how many years would you wait to get the $10,000 back? Now, I also do real estate. So in the real estate business, the rule is like 7 to 8 years. So if you invest $100,000 in 7 or 8 years, you hope to make back the $100,000. If you make back the $100,000 7 or 8 years, it's considered a good investment. That's a P ratio of 7 or 8 because it takes 7 or 8 years to make back what you want, what you're getting. So the S&P 500, as the way that we know it, with 11 sectors, with the 500 stocks, with that's voted in, has been out since 1957. So I mentioned that. I mentioned that in other videos. I write about it because it's very important. It's not what Nathan says. It's what the world considers the stock market. So the stock market, S&P 500, normally trades, not right now, but before the pandemic, trades 17, 18 times earnings. So that means the stock price of the company right now trades at 17 to 18 times how much they make a year, which means in 17, 18 years, you make your money back. So to do that, normally a company in the S&P 500, year over year, they have earnings of 5 or 10% increase in earnings, and sales increase at 10 to 20%. So a company that's trading lower than 17, 18 times earnings, right? Lower than 17, 18 times earnings, but grows faster than at least 10%, grows sales faster than 10%, and grows earnings at faster than 5% year over year, should trade at above 17 or 18 times earnings, right? Because it's growing sales faster than most S&P, and it's growing earnings faster than most S&P. So you can give stocks like that a higher than 17 to 18 times ratio. Because a lot of people ask me, how do I value things? So the way I value stocks, that's basically what I look at. I look at the S&P 500. I look at how it's been over time. So if I want to pay 30 times earnings or 40 times earning, it's got to grow at higher than 20% a year over year in sales. It has to grow at earnings of more than 10% year over year. Why is that? Because S&P 500 is 17 or 18 times earnings, grows sales at 10 to 20%, earnings 5 to 10%. So that's why tech stocks, you can give tech stocks a lot of times higher than 17 or 18 times because they're growing sales faster than 10 or 20%. They're growing earnings faster than 5 or 10%. So that's what we look at. Another ways to raise shareholder value is to buy back shares. Because when you buy back shares, you're taking supply out of the stock market. You're increasing demand also because you're buying back shares. You yourself, you have deep pockets. So you're raising shareholder value. If you invest in a company, if you lower your expenses, buying back debt, you're raising shareholder value. If you're growing faster sales than S&P, faster earnings, you're raising shareholder value. So I write that a lot of times because people understand, like when I say, why are you buying this company? They do not raise shareholder value. So not raising shareholder value, examples, a company that has massive debt that cannot make enough money to pay off even the interest. Of course they're going to use EBITDA. The interest that they're paying in the debt is higher than the money that they make. So obviously it can never be profitable. A company is selling a lot of shares. Definitely not raising shareholder value. If a company is decrease in sales, decrease in earnings, there are companies like AMC, Bed Bath & Beyond, Carvana, they're all crushing shareholder value. They're selling a whole bunch of shares. They do not have the sales that they once had years ago. And why are people buying these stocks? Because retail, I don't get it, but raising shareholder value. Okay, you want to buy stocks that raise shareholder value.